Everyone, hope they're having a good day. My name's Andy. My channel is Finding Value. Today we're going to go through Twitter, see what people are sharing on social media. I'll interject my financial opinions as we go through it. It's generally related to three different topics: wealth building, commodities, and/or financial topics. Let's dive in, take a look, see what people are sharing. If you want to follow me at @Finance, and if you want to join our community, finding-value.com, where I dive deeper into all of these topics and subjects, looking for potential investment opportunities for everyone in the community. I also share my opinions, my experiences of my investment experience since 2004. That's when I started investing and learning. Obviously, when I first began, I didn't know all that much. Definitely struggled through the ending portion of the first commodity bull market that I experienced, which I came into the middle of one, watched the end of it, and then watched the entire cycle absolutely rip for technology and regular S&P 500 stocks from 2009 all the way to 2024, 2025. We do have a special coupon code if you'd like to join. Special is that coupon code. And you get 50% off the first month only on the monthly membership, and a larger discount on the yearly membership if anybody would like to switch from the monthly to the yearly or sign up directly to yearly. So Kevin Bambro says when Z, that's the leader of China, says lend, they lend. Commodity bull is coming, in his opinion. And I think he's tying it a lot with China. And this is China's government bond sales drives broad credit growth. Loan expansion picks up on short-term corporate borrowing, household demand. And this is outstanding stock of loans to real economy, aggregate financing, and it's starting to bottom and turn upward. I know a lot of people are focused on the United States. They're focused on if we're going to go into a recession. But there's also in the background, China already went through a slowdown. They went through we'll call it a recession in the real estate cycle, which impacted everything. They do have a smaller demographic of home buyers coming into home buying years than previous years, but there's a lot of lending going on, and that could have an impact on the demand for commodities. Another one from Kevin Bambro. I thought this was kind of funny because it's so true. Nobody knows what's going on, not even those trying to front-run Trump's announcements with the White House, sources in a Signal chat group. We are at the point where Trump can't even remember what he's tariffed and what he has exempted. I guarantee you Trump is unable to recall the moves he's made in the last few weeks. Literally, the only people who know what's going on are the ones that realize that no one knows what's going on. The plan is to cause everyone pain and hope that some concessions are offered, and then victories can be declared. And I agree with that. I don't know what's going on. There's been so many tweets going on and so many things where they have changed and or reversed their original tariff opinions. I think they're opinions. I don't even know what they are. Statements, opinions, because if you make an opinion, we'll set it at this amount, and then they change it, and then they change it, and then they reversed it, and then they changed it again. Who knows what it is? And I don't even know if the markets are playing with this anymore. It's hard to say. But I can tell you this, it's definitely uncertainty. Mena Backer says OPEC lowers its demand growth forecast this year to 1.3 million barrels per day from the previous forecast of 1.45 million barrels per day for growth. U.S. tariffs are part of the reason for the downward revision. And then next here, it says Brent's crude plunge below 60 was an overreaction to tariff fears, says Gunvor Frederick Lazure. Markets assumed zero demand growth, but the research head sees more upside ahead. There's a better exit than the zero growth situation. So the market is maybe pricing zero growth, and OPEC lowered its growth to 1.3 million barrels per day. So 1.3 million is obviously larger than zero growth. And maybe the market has mispriced oil prices. Maybe it's too low. We'll see. But that's some information there that people are looking at. HFI Research says April and May will be extremely important months in deciphering where U.S. shale oil production is headed for the rest of 2025. Associated gas production remains strong, while implied crude production is already falling. More weakness ahead is our base case in terms of supply weakness, not demand weakness. So this is oil coming on up, and it looks to me like it's rolling over, ready to potentially maybe fall. If we get growth in demand growth and we get a decline in supply, well, then we could eat through spare capacity pretty quick. That is a potential possibility. Eric Nuttall says physical demand is up 1 million barrels per day year over year in April. So this is looking backwards. This is not a projection. It is a fact, or, it's looking backwards for metrics. While oil financial demand last week fell by the biggest weekly drop on record to levels that have resulted in a price bottom. Very challenging to be bullish, but signals to be optimistic that the worst for now may be behind us. And I'm not sure if that is necessarily true or not. We've got the biggest flip-flopper in tariffs going on, and I have no idea what the ramifications are of those tariffs. They very well could put us into a recession. The yield curve is inverted, and the yield curve has been dropping some. And if the tariffs do get implemented, there is definitely a possibility that we could go into recession. Everything is aligned in terms of the yield curve, in terms of inflation slowing down, where that could occur. Now, there are some things that are still in the system that are stimulative. For instance, large fiscal deficits. That is stimulative. I think they're currently around 8 or 9% of GDP. So they're spending 8 or 9% more than GDP running that deficit, which is a very big deficit. And large deficits are stimulative. So who's going to win in the end of this thing? Are the tariffs going to be a large enough jolt where it shocks the system into a recession? And I think a lot of people are pricing that in already. We also see weakness in the S&P 500, and that looks pretty weak on the charts. So yeah, we could come back up, but easily roll over again and see more selling pressure in the markets. So I think it's really difficult to make a call here in either direction. If the tariffs don't go through, or things are negotiated and they're favorable, and we don't really have much tariffs, maybe that's a positive. Maybe we actually improve our tariff situation with all the other countries. That would be the best outcome. Maybe it's a disaster and we get a recession. So I mean, it can go any way here, guys. I really don't know. It's a tough call, and a lot of stuff is shifting underneath us in these markets that we don't really know which way it's going to go. Nassim Taleb says, remember that nobody accepts randomness in his own success, only his failure. I don't know if it's randomness, though. I mean, some people will attribute things to randomness, like, oh, it was random. Well, I'll say this. A lot of people who are successful, they may not be successful every single time, but they put themselves in the position where randomness can make them successful. Does that make sense? So, for instance, Elon Musk built businesses in a certain sector. The randomness, to some degree, is that the sectors that he chose did very well, and money was flowing into those sectors where he built his businesses. So that is a positive, but he still built the businesses. He was still there. If no one was trying to build the business and they weren't doing anything, they have no chance of randomness to help them. Now, as the market conditions determine who the richest people are in the world, that is based off of luck. So you can start a business to some degree, unless you know the cycle that we're in, and build a business during your lifetime. And I'm sure you guys have noticed this. All of the richest people, for the most part, are in technology areas right now, because technology is what grew the fastest. That's where the money flows and the market conditions supported it. They went from an undervalued state to an overvalued state. And for the most part, a lot of these guys were in this cycle from the beginning to the end. They started companies in the early 2000s or before, maybe the 1990s. We had a big tech boom. We had a tech bust, and then we had another tech boom from 2009 to where we are today. So it's by no surprise that Jeff Bezos, Mark Zuckerberg, all these guys are all the richest people in the world. But that required some randomness. It required them to open these companies in the right sectors and money flow to go into those sectors to be the richest. So you could be in a variety of different sectors, and to be the richest in the world and build companies, there's a lot of randomness and luck to it. That your product or company is in the right place at the right time, selling the right thing. And that's where the randomness or luck comes into play there. And then you have money flows coming into it as well, which then amplifies that luck. Coming into Katusa Research, silver looks cheap compared to gold right now. When 1 ounce of gold buys 100 ounces of silver, like today, silver usually jumps much higher than gold in the next rally. And I completely agree. If you look at this ratio, the majority of the time has spent, I would say, between maybe 50 and 85. So 50 and 85 is the majority. So 50 somewhere like in here, and then 85 is in here. And that's the majority of where this spent its time. So if you were to do a normal distribution, your average would be around maybe 60 or 65 or 70, somewhere in there. And then you get these tails. And every time you buy the tails, silver here, maybe perhaps swapping your silver to gold down here, that's how you make all your money. It's not about guessing what the market will do. Obviously, the market conditions are favoring gold right now in relationship to silver. Maybe it is gold buying by central banks, and they're not buying silver. Maybe the market conditions is a more fear-driven market condition where a potential recession could come and people more so buy gold than silver in those conditions. And eventually those conditions will change and silver will be preferred, and this ratio will go back to perhaps normal levels, but probably blow past normal levels to an expensive state. That's just playing the ratio. So it is smart, in my opinion, to buy things where the ratios are favorable for whatever commodity is favorable for how cheap it is, for being undervalued. If you're over 100 to 1, silver is favored. That's what you want to buy. Even if it takes a little bit of time for it to reverse, that's where people would accumulate. You accumulate when things are cheap. You sell when they are expensive, or swap to when they're very expensive. Depending on how long your time frame is, there may be times where you don't sell, even when it's overpriced. You ride it through many, many market conditions where you just ride a certain company all the way up. That's the Warren Buffett approach, the Charlie Munger approach. People would ask them, well, when's a good time to exit? Their answer is never. I'm trying to find companies where I never have to sell it. And that's just a different mindset. So they're not good at selling because they're trying to find companies that they never want to sell. And those are companies that don't go out of style. So they generally buy companies that are not tech companies, because tech companies, you develop something and then it generally goes away. It gets replaced by something else. Sony Walkmans to CDs to MP3s to everything being on your phone, and whatever else comes next. I don't know what's next after that. So what they do is they end up buying like boring companies that everybody uses, that expands over time. Technology, they benefit from technology. So it'd be like food companies, beverage companies, insurance companies, maybe perhaps real estate companies and banks, things like that. And then they just buy it and never sell. That's really what they do. So you could mimic what they do. Wait for a good buying opportunity. Maybe we get a good buying opportunity in 6 months to a year or something like that, where people get afraid, they sell off the S&P 500, and then we've got a bunch of potential buying opportunities in some of those companies. And then you buy them up. High Heat says OPEC produces 40% of the world's oil. Their supergiant fields were found from the 1930s to the 1960s. Ghawar, which is the largest oil field in the world, has been producing for 71 years. What's the decline rate of these old supergiants? It's a state secret. This is where we could see a problem in oil. All of the big oil fields are already found. Other people will say, well, it's just a matter of price. No, it's not. I hate to say it, guys. We have not found any supergiant fields from, even in like the 1980s. I think was like the last time we started finding anything that was of any size. A lot of stuff that we found more recently has been a lot smaller, and it will not replace or even come close to the supergiants. The supergiants produce a few million barrels per day, and Ghawar I think it peaked at 4.5 million barrels per day. So one oil field was producing about half of what the United States was conventional oil production, and it produces about half or a little less than half of Saudi Arabia's production. I know that the water cut coming out of that field is going way up. Matt Simmons, he was an oil analyst. He would talk about the water cut back in the mid 2000s and how that was increasing. So these supergiants, I think, are going to roll over, which almost all of them have. One supergiant that maybe people know is Mexico's supergiant. I believe it's called Cantarell. Cantarell is it's peaked. So is Ghawar, that's peaked. Now it's just, what's the decline rate look like? The problem is we're trying to replicate these large losses in these big supergiants with an accumulation of a bunch of smaller fields. And we have to drill like heck to keep them going. I'm not sure if we can do that forever. At some point, these super giants, when they start to decline and they decline to levels that we can't do that anymore, that's where we're going to get a problem. And I think we are entering that era here pretty soon. I think 2020s we will hit a peak. If not, it'll be early 2030s. But that's not when the problem will exist. That's when we have a dire situation. The problem will exist when demand starts to outpace supply, and the price starts going way up. And then after that, we could see a decline where there's a gap between demand and supply. And there won't be a gap. The price will solve that. It just means that we have to go to demand destruction. So looking backwards, the entire time that we have been producing this gigantic economy, we've been riding the cost curves of supply. So we've always had more supply out there than demand. And we've been riding the cost curves of the high cost producers up, and up. If we get to the turning point and it turns lower on supply, we would be riding the demand destruction price from that point forward. And we would go back and forth between demand destruction, then we would probably have a recession or something, which the prices would drop back to high cost producers, and then we would spike again and have to come back down. So we would see these gigantic spikes in the market where demand needs to be killed off, and then the eventual turn in supply from geological constraints. And I don't think our currency system will survive that. I just don't think it will. Remember all those people bearish gold when it was half the price? I was never bearish gold. I was bullish gold, and a lot of people, they try to play the short term. If you've been bearish gold or if you've been bullish gold your entire life, you pretty much won. Especially if you're a baby boomer. I mean, if you started working in the early 1970s and you just bought gold the entire time, you would have been one. You would have done very, very well, because you have all your money outside of the system. Nobody knows you own it, and you could just retire off of it. And it went up massively in the 70s, 80s. It went sideways, and 90s it went sideways, and then you had a massive move from 98, 99 all the way till today, and you don't have to do anything. You don't have to worry about it. It just goes up. Pretty easy. Nick says oil slumped below 60 a barrel during the worst of last week's rout, had priced in zero demand growth this year, and was probably an overreaction. And he says probably an overreaction. You think market reacted as if the entire global economy is going to shut down. Maybe that's priced in. Maybe they have it wrong. Maybe they're forward looking, and maybe the tariffs are worse than what we think, but nobody knows what the heck the tariffs are going to be. Here's Jordan. So Jordan says, how do gold stocks perform after single massive gains in a single week? Last 3 times this happened were immediately after the lows in 2020, 2016, and 2008. In 2001 to 2003, it happened at interim peaks or at a start of a significant breakout mid-2003. Gold stocks successfully retested their breakout last week. It's bullish. 2003 is best but not perfect comparison for the Huey's bug. And these are the time frames that he's looking at, these blue lines. And a lot of the times it's been pretty good. It's been a positive signal. Here's another one from Jordan, and I completely agree with this. I really wanted to read this one. He says, too many are stuck in the 2008 or 2020 playbook. Bonds are in a secular bear market. I talk a lot about that, about the yields breaking to the upside of the 40-year downtrend line. He says this was not the case in 1929, 1937, 2000, 2008, or 2020. For a huge chunk of the 1970s, precious metals were inversely correlated to stocks and bonds. Bonds have lost their safe haven status to gold. Money that normally buys bonds is buying gold. The same happened in the mid-1960s. First, to gold stocks, which was the only way to own gold then, and then gold after 1971 when it became freely traded. The 2008 boogeyman has conditioned everyone and their dog that there has to be some big decline before precious metals can go higher. This isn't 2008. It's actually worse because both stocks and bonds are in a secular bear market, just like 1966 to 1982. And that means it's better for gold, silver, and other hard assets. So what he is talking about, if I were to break this down, what he is saying is everyone is using the playbook in a declining interest rate environment. In a declining interest rate environment, there was always the option to buy bonds. Bonds go up when interest rates go down. What he's saying is happening today, which I totally agree with, is that we are in an increasing interest rate environment. This is a condition where both bonds and stocks can go down together. What that means is that even more money is going to rotate out of bonds and stocks simultaneously and look for alternative investments. Gold is the preferred alternative investment to bonds because bonds are not the safe haven like 2020, 2008, 1929, and all those other time frames going back in history. This could be a much stronger move to the upside in gold and hard assets than what most people are prepared for. That's what he's saying. Totally agree with him. Totally agree. We got freight futures, AM update, dry bulk, Capesize, and Panamax are both up 2%. Tankers are both up. VLCC up 2 and Suezmax up 1. Here's Grady, and I agree with this. It says the silver to gold ratio here, which is the reverse gold to silver ratio, has a cleaner pattern than GSR. When this ratio moves up, silver outperforms gold. Go time is when the purple pattern breaks out. Now, holding black support with bullish reversal intramonth looks like a final back test here. And this is the expanding falling wedge, usually a very bullish pattern that we will eventually break out and silver will outperform gold. And you guys have seen gold's chart. It's going up absolutely vertical. So silver, I think, will go vertical at some point very soon. And that's when the market conditions will change. I think platinum will go up too, a whole bunch. So it's coming. It's coming. Here is the real fly. So he says the dumbest part of this whole tariff implementation is it penalizes American companies who sourced overseas overnight. This wasn't illegal, and they sought out low pricing to compete. It is incomprehensible that the administration would simply press a button and declare all of these businesses to be null and void, all for the sake of reshoring. If serious, there needs to be a process that allows companies to transition to domestic production. I actually completely agree with that. In fact, the way that this was brought up could have been done on purpose to destroy certain companies if people weren't thinking about that. So some companies are based off of taking advantage of the low labor costs in other countries. And I find it really weird and difficult to believe that they just brought this out of nowhere and that these companies could be, quote, null and void. That is a major no-no in my opinion. But that's what I've got for today, guys. We're going to end it there. Give me a thumb up for the content. Subscribe to the channel. Subscribe to the website. Specials, that coupon code. And that's all I've got for today. So we'll catch you next time. This is Finding Value.